The concept is simple: buy low, sell high, and repeat often. But why do so many investors and professional money managers struggle with such a simple concept? A detailed report, 92 pages if you want to read the whole thing, from professors at MIT and the University of Chicago has the answer. I'll go over that first, and then I'll tell you how to use the information so that you get returns that other stock market investors can only dream of. The report is called Selling Fast and Buying Slow. They analyzed the results of 783 portfolios of wealthy investors and institutional investors like pension funds and hedge funds. They compared the results of those funds with the results of babies. That's right, diaper-wearing youngsters who could not spit out the word buy. They let those babies randomly pick stocks by pointing at a screen. When deciding what to buy, the professionals outperformed the babies by just 1.2%. Even more interesting is that the babies outperformed the professionals when it came time to sell. And it isn't just babies that are making predictions that are just about on par with the experts. In sports, there are a variety of animal prognosticators, and some of them have had unbelievable results with their predictions. Vulcan the lion, currently residing at a zoo in Utah, was undefeated with his Super Bowl picks, correctly guessing the Super Bowl winner 3 times in a row. His luck ran out, though, and he eventually picked the wrong team after choosing the Eagles to beat the Chiefs in 2023. But hey, he did redeem himself in 2024, successfully picking the Chiefs to beat the 49ers. Anyway, so we have babies and animals making expert picks and not being too far away with their success compared to the experts, which brings us to an interesting takeaway. How are the results between professionals and, we'll just call them non-professionals, so similar? If we go back to Selling Fast and Buying Slow case study, we'll get the answer. The primary point of the report is to point out that humans, even professional money managers, make decisions based on emotion. They show that fear and greed often lead to poor decision making, and that completely random, non-emotional decision making can equal or even get better results. So, how do you remove your emotions from stock picking? Simple. Stop being a human. Or you could try a different approach altogether. And while you're trying something new, you could like and subscribe this video for more content like this in the future. We often preach that you should not try to buy low and sell high because you have to pick the right stock at the right time and sell at the right time. Studies have shown that over 90% of investors do this poorly and do not make money in the stock market. The classic saying here, popularized by people such as Ken Fishers, is that time in the market beats timing the market. Think of NVIDIA. Some people bought NVIDIA for around $125 a share back in October of 2022. They were pumped to see their investment double, so they sold at $250 in March of 2023. That is less than 6 months, and they doubled their money. But they were saddened to see that if they had continued to hold for the long term, that 2x could have turned into a 7x return. They tried to time the market instead of maintaining time in the market. So how do you do that effectively? We solve this in 2 ways. First, for the portion of our portfolio that is allocated to the stock market, we focus on stocks or ETFs that pay a sizable dividend and or have strong fundamentals. With dividends in particular, whether the underlying value goes up or down, we make money. We acquire those assets and hold them for a long time so that we make money every year for a long time. Even the babies can't beat that performance. The second way we solve the problem is by diversifying into assets that are completely unrelated to the stock market. We diversify across 6 different markets, and the stock market, which includes stocks, funds, and ETFs, is just one of those 6 markets. The best part is that all of the other 5 markets historically outperform the stock market. Not only do we get better diversification to avoid drops in the stock market, and so they don't impact our return, but we also get higher returns. The long-term average for the S&P 500 and the Dow are between 9.5% and 9.9% per year on average over the last 30 to 50 years. Our lowest returns outside of the stock market are fixed investments secured by real estate that pay 12% per year or more. Many of the other opportunities we have found pay between 20% per year and 50% per year, and more than 10 of them actually double every year. When people think about investing, the first thing they think of is about the stock market. But the most important thing to remember is this: the stock market is investing, or if you frequent Wall Street bets too much, you might call it gambling. But investing, though, is not only the stock market. There are many other great vehicles that you can use to build your wealth. If you want to learn more about our diverse portfolio strategies, you can go to www.unbrokeninvesting.com. And as always, live richly. Before I finish the video, please take a second to like the video. If you haven't already, please subscribe so you get more fresh content on how to build passive cash flow. Finally, if you have any family or friends who would like to improve their financial position, please share this video with them. Thanks, and I appreciate that.